$1.4 billion. That's how much Blue Owl Capital, one of the largest alternative asset managers on Wall Street, just scrambled to sell in a matter of days. And if you think that's just some boring financial headline that doesn't affect you, I need you to stay right here, because what happened this week on February 19th, 2026, may be the clearest warning signal we've seen in the financial system since August 2007. I'm going to show you exactly what Blue Owl did, why the smartest economist in the room compared it to the event that triggered the 2008 global financial crisis, and what this means for every single person watching this video right now. By the end of this, you're going to understand something most people won't figure out until it's too late. Let me set the scene. Blue Owl Capital manages $295 billion in assets. These aren't garage sale investors. This is one of the biggest names in private credit, a sector that has exploded from essentially nothing 15 years ago into a $3 trillion market that touches virtually every corner of the financial system. They lend money to mid-sized companies, tech firms, software businesses, the kind of companies that can't just walk into Goldman Sachs and issue a bond, so they borrow from private credit funds instead. Blue Owl has been one of the kings of that world, until this week. On February 19th, 2026, Blue Owl announced it was selling $1.4 billion of loans across 3 of its funds simultaneously. And, this is the critical part, it permanently halted quarterly redemptions in one of its main retail-facing funds, a vehicle called Blue Owl Capital Corporation 2, or OBDC2. Investors who had been counting on getting their money out on a quarterly basis, the door just closed. Not temporarily, permanently. No more quarterly tender offers. Blue Owl stock immediately plunged 5.9%. But here's what really set off alarm bells across Wall Street. Shares of Ares Management, Apollo Global Management, Blackstone, KKR, and TPG also plunged the same day. The whole sector got hit. And Mohamed El-Erian, former CEO of PIMCO, one of the most respected financial minds alive, asked publicly, and I'm paraphrasing here because copyright matters, but he asked whether this was a canary in the coal mine moment, similar to August 2007. He actually used the phrase August 2007. If you know your financial history, that date should send a chill down your spine. So let me take you back to August 2007, because this isn't the first time we've seen this exact playbook unfold. In August of that year, 2 hedge funds run by Bear Stearns collapsed after suffering catastrophic losses on subprime mortgage-backed securities. A few weeks later, the French bank BNP Paribas froze withdrawals from 3 of its own funds, saying it simply couldn't value the underlying mortgage assets anymore. Credit markets tightened almost overnight. Banks stopped trusting each other. Liquidity, the lifeblood of the entire financial system, began to dry up. On the surface, stocks held together for a few more months. The S&P 500 actually hit its all-time high in October 2007, but the rot was already spreading underneath. What seemed like an isolated credit event in the summer of 2007 spiraled, slowly at first, then all at once, into the worst global financial crisis since the Great Depression. Does that mean what happened with Blue Owl this week is the 2008 crisis repeating? No, absolutely not. And I'll be honest with you about what's different. But the structural similarities are real enough that some of the smartest people in finance are paying very close attention right now. And you should be too. Let me show you exactly what those similarities are, because the data is genuinely alarming. Quick note for those of you who aren't subscribed yet. My analytics tell me that roughly 3 out of 4 people watching this video right now haven't hit subscribe. If this kind of research-backed, data-driven analysis is cutting through the noise for you, hit subscribe right now. That's how I know who the committed community is. It helps me keep making content like this, and it helps the algorithm get this in front of more people who need to see it. Now back to what matters. Here's what you need to understand about private credit, because this whole story lives and dies on whether you understand what this market actually is. For most of financial history, if a company needed to borrow money, it went to a bank. Banks took deposits, made loans, everything was regulated, everything was visible. After 2008, banks got hit with massive new regulations, the Dodd-Frank Act, higher capital requirements, and they pulled back dramatically from lending to riskier, mid-sized companies. That created a void, and into that void stepped private credit funds. These funds raise money, often from pension funds, insurance companies, and increasingly from retail investors like you and me, and they lend it directly to companies that can no longer easily access bank financing. The appeal was massive, yields of 8% to 16% at a time when savings accounts paid basically nothing. The sector exploded. From roughly $500 billion in 2015, private credit ballooned to over $3 trillion by 2025. Blue Owl's OBDC-2 was part of that wave. Launched in 2017, it raised billions from so-called retail investors. Now, to be fair, retail here means accredited investors, people with a net worth of over $1 million or high incomes, not your average person. But here's the structural problem that was always baked into this model like a time bomb. Private credit funds lend money to companies through loans that typically don't trade on any open market. They're illiquid by nature. You can't just sell them like you can sell a share of Apple. They're locked up. And yet, funds like OBDC-2 promise their investors something that sounds reasonable on the surface. The ability to redeem, to get their money back, on a quarterly basis, up to 5% of the fund's value at a time. It sounds orderly. It sounds manageable. Until too many people try to leave at once. Think of it like a bathtub that's slowly draining while the faucet has barely a trickle. For a while it works fine, but the moment the drain opens wider than the faucet can fill, you've got a problem. And that's exactly what happened at Blue Owl. According to documents and reporting from Alternative Credit Investor, redemption requests at OBDC-2 had already exceeded that 5% quarterly cap. And at Blue Owl's tech-focused vehicle, OTIC, redemption requests jumped all the way to approximately 15% of net asset value in just a single quarter. 15% of people saying, "I want out, right now," in a fund that can only process 5% per quarter. That's 3 times the fire exit capacity and a theater filling with smoke. So what did Blue Owl do? They scrambled. They went out and sold $1.4 billion in loans to a group of North American public pension funds and insurance companies. The loans from OBDC-2 alone represented about 34% of that fund's entire portfolio. Think about that. They sold a third of the fund's assets in one transaction. OTIC sold about $400 million, roughly 6% of its commitments. The main Blue Owl Capital Corp fund sold another $400 million, about 2% of its portfolio. Total, $1.4 billion moved in one shot. Now, Blue Owl will say, and did say publicly, that these loans sold at 99.7 cents on the dollar, nearly at full value. And that's true. That's actually a strong outcome and worth acknowledging. They didn't have to take a catastrophic haircut. But, and this is the part that matters, the reason they could sell those specific loans at par is because they cherry-picked the most liquid, most desirable assets in the portfolio, the cream. They sold the cream to generate liquidity. What's left in the fund now? The rest. And the rest is harder to sell, harder to value, and concentrated in sectors under serious stress. Here's where we need to talk about software, because this is the accelerant on the fire. Private credit funds, including Blue Owl's vehicles, made enormous bets on software and technology companies. The thesis was simple. Software companies have recurring subscription revenue, low capital needs, and predictable cash flows. Perfect collateral for loans. And for years it worked beautifully. Then AI happened. Not in a good way, at least not for companies that had borrowed heavily against the assumption that their software products would remain dominant. According to SaaStr's analysis of current market data, software price-to-earnings multiples have collapsed from roughly 30 times EBITDA at the end of 2022 to about 16 times today. Software revenue multiples went from 10 to 12 times down to about 4 times. When that happens, the collateral value of these loans, the thing backing up the money that was lent, gets cut roughly in half. And the S&P 500 Software and Services Index has lost approximately $2 trillion in market cap since October. About 13% of the loans Blue Owl was selling are tied to that sector. The SaaStr analysis makes a chilling observation, that private credit's true exposure to software is actually larger than reported, because at least 250 loans to software firms worth more than $9 billion were categorized under different industries by various BDCs. A pricing software company classified as business services, a restaurant software company classified as food products. The real exposure is hiding in plain sight. Now let me show you the broader picture, because Blue Owl didn't develop this problem in isolation. This is an industry-wide stress event that's been building for months. According to data compiled by 24/7 Wall Street, drawing on public filings, the entire BDC sector, that's business development companies, the category Blue Owl's funds fall into, has taken a 23% drawdown over the past few months. 23%. And the maturity wall is coming. 23 out of 32 rated BDCs have unsecured debt of their own maturing in 2026, totaling $12.7 billion. That's a 73% increase over what matured in 2025. These funds need to refinance their own debt at the same time their underlying borrowers are struggling to service theirs. BlackRock TCP Capital, one of the other major BDC players, saw its net asset value fall by 50% in a single year, with non-accrual loans, loans where the borrower has stopped making payments, reaching 4% of its portfolio. Golub Capital, which manages an $8.6 billion portfolio with about 26% exposure to software, already cut its dividend by 15%, and analysts are forecasting another 10 to 20% cut on top of that. And here's the data point that should make everyone sit up straight. According to WithIntelligence's private credit outlook, while the headline default rate in private credit appears below 2%, once you include selective defaults and what the industry euphemistically calls liability management exercises, which is Wall Street speak for renegotiating terms with borrowers who can't pay, the true default rate is actually closer to 5%. 5%. Meanwhile, a growing portion of loans are being paid in what's called PIK, payment in kind, meaning borrowers aren't paying cash interest. They're rolling the interest into more debt, more borrowing to cover the inability to pay current borrowing. Sound familiar? Stick with me because this next part is where it all connects. There is a structural feature of private credit funds, especially the non-traded, retail-accessible ones like OBDC2, that creates a dangerous illusion for investors. These funds often report their net asset values, or NAVs, based on internal models and quarterly appraisals. They're not marked to market every second like a publicly traded stock. That means there can be a significant lag between when the underlying assets deteriorate in real value and when the fund's official NAV reflects that reality. OBDC, Blue Owl's publicly traded BDC, was trading at a 20% discount to its stated NAV when Blue Owl proposed merging the two funds in November 2025. 20%. The market was effectively saying, "We don't believe your internal valuations. We think these loans are worth less than you're telling investors they are." And the market priced it accordingly. This is the paper versus physical problem translated into credit markets. The official number says one thing, the actual market price says something 20% cheaper. In precious metals, we talk about the difference between paper gold and physical gold. In private credit, the gap between stated NAV and real market price is the equivalent phenomenon, and it matters enormously when investors try to exit. Here's what makes this truly alarming, and I'm going to walk you through the timeline of how these things unfold because we have historical precedent. When BNP Paribas froze its funds in August 2007, it was a Tuesday. The initial market reaction was contained. Equity markets shrugged. Smart money started quietly repositioning. The public kept investing, kept buying, kept trusting the official numbers. By March 2008, Bear Stearns had collapsed. By September 2008, Lehman Brothers was gone. AIG was being bailed out, and Congress was scrambling to authorize $700 billion in emergency funds. Now, and I want to be crystal clear about this, the private credit situation today is not the subprime mortgage crisis. The loans aren't packaged into toxic CDO squared derivatives. The counterparties are different. The regulatory environment has changed. Mohamed El-Erian himself said the risks don't appear anywhere near the magnitude of 2008. But the structural mechanic, illiquid assets, liquidish redemption promises, investor panic, forced selling, and contagion across similar funds, that mechanic is identical. And once it starts, it's very hard to stop. Dan Rasmussen, founder and advisor at Verdad Capital, told CNBC directly, "This is a canary in the coal mine. That's not some random blogger. That's a professional fund manager watching his own industry." Now, Blue Owl came out the next day and pushed back hard on the narrative. On February 20th, 2026, they posted a clarification statement saying, I'm paraphrasing carefully, that instead of resuming a 5% quarterly tender, they're distributing an amount 6 times larger and returning capital to all shareholders within 45 days. They're calling it an acceleration of capital return, not a halt. And they're not wrong that 30% of NAV in a single distribution, approximately $2.35 per share, according to their own disclosure, is a better outcome for investors than the previous failed merger proposal, which would have forced some investors to take a 20% loss. But here's the question you need to ask yourself. If everything is fine, why did Blue Owl's own shares fall nearly 6%? Why did Blackstone, Apollo, Ares, KKR, and TPG all fall simultaneously? Why did ETF analyst Eric Balkunas from Bloomberg warn publicly that this would erode trust in funds with 5-letter tickers, the non-traded vehicles that retail investors have been pouring money into? Why did Blue Owl shareholders file a lawsuit alleging the firm failed to disclose pressure on its asset base caused by BDC redemptions. Why is all of this happening at once? Because the market understands something that the press releases don't say out loud. The era of easy money in private credit is ending. The question is whether it ends with a controlled wind down or with something that looks a lot more like 2008. Let me show you the mathematical impossibility of how this was always going to end. The private credit industry grew from roughly $500 billion to $3 trillion in a decade. It did that by promising investors something that had never really been tested at scale: illiquid assets with semi-liquid exit options yielding double-digit returns with rock-solid valuations. Pick two of those four. You cannot have all four simultaneously when markets go against you. The AI disruption to software, the single largest borrower category for BDCs, is forcing a repricing of collateral values across the industry. Software EBITDA multiples cut in half. Apollo, perhaps the most sophisticated credit shop on Wall Street, cut its software exposure nearly in half during 2025, moving from about 20% down to roughly 10% of its portfolio. When Apollo is quietly de-risking from a sector that aggressively, pay attention. They don't do that because they think everything is fine. The SaaStr analysis puts the total private credit exposure to software companies at $600 to $750 billion, with 20 to 25% of a $3 trillion market concentrated in a sector now under existential technological pressure. And SaaStr's conclusion, based on current trajectories, is stark. A sustained credit tightening that starves software companies of refinancing, forces fire sales, and creates a wave of quiet defaults across 2026 and 2027. And unlike the SVB collapse, where the government stepped in over a single weekend and guaranteed everyone's money, this will be, to use their words, slow, opaque, and ugly. Company by company, loan by loan, markdown by markdown. So what does all of this actually mean for you? I'm not a financial advisor, and nothing I'm saying here is financial advice. Your situation is unique, and you should consult a licensed professional before making any investment decisions. But let me give you the framework I think everyone needs to understand right now. First, if you own shares in any non-traded BDC or private credit fund, especially any fund that has been offering you quarterly redemption options, you need to understand what you actually own. These aren't savings accounts. They're not government insured. The liquidity you think you have exists on paper, but it is conditional. It can be taken away. That's not a conspiracy. It's in the fund documents. OBDC2 investors found that out this week. Second, the maturity wall is real and coming fast. The BDC sector faces $12.7 billion in its own debt maturing in 2026. That's a 73% jump from 2025. 23 of 32 rated BDCs need to refinance. That refinancing needs to happen in an environment where credit conditions are tightening and lenders are growing nervous. If some of those refinancings fail, the fallout doesn't stay contained within the BDC industry. Third, watch dividend sustainability across the sector. Golub Capital already cut 15%, with another 10 to 20% projected. BlackRock TCP Capital saw its NAV fall 50% in a year. These aren't small numbers. When funds that have been advertising yields of 11 to 16% start cutting or eliminating those payouts, retail investors who built income plans around those distributions face a very painful recalculation. Fourth, understand the SaaS exposure risk. If you own any private credit fund, dig into its portfolio disclosures and look for software company exposure. According to Bloomberg's analysis, that exposure is often larger than disclosed. Look for companies categorized under business services, technology, and software, but also look hard at other categories that might be concealing software loans. The collateral on those loans has already lost roughly half its value in market terms. Fifth, keep your eyes on publicly traded BDCs as the early warning system. Publicly traded BDCs like Blue Owl's OBDC price in real time, and their discounts to stated NAV tell you something crucial. They tell you how much the market trusts the official valuations of non-traded vehicles in the same sector. Right now, OBDC was trading at a 20% discount to stated NAV before the Blue Owl restructuring. That's the market's verdict. Sixth, watch for other fund gates. Blue Owl is not alone. If you see other non-traded BDCs or private credit vehicles announce changes to redemption structures or strategic alternatives or orderly wind downs, understand what those phrases mean in plain English. They mean demand for exits is exceeding the fund's ability to process them. And seventh, don't assume this is fully contained. That doesn't mean panic. Panic is never useful. But the sequence of events, from BNP Paribas in August 2007 to Lehman Brothers in September 2008, took 13 months to fully unfold. In that 13 months, there were multiple moments when people said, "This is contained." They were wrong. Not because the risks were hidden. The signs were there the entire time. The data existed. The reporting was available. The people who paid attention and adjusted early were in very different positions by the end of 2008 than those who trusted the press releases. The private credit boom of the last decade was, in many ways, a direct child of the 2008 crisis. Banks retreated, private funds filled the void. They provided genuine economic value, capital to companies that needed it, yield to investors who craved it. But like every financial innovation driven by cheap money and a decade of artificially low interest rates, it grew faster than the underlying risk could be properly managed. And now rates are higher. Software, the sector that was supposed to be the safest collateral, is being disrupted by AI. The maturity walls are arriving, and the investors who were promised liquid exits from illiquid assets are discovering the fundamental tension that was always embedded in that promise. Blue Owl's Craig Packer said the loan sale at 99.7% of par was a strong statement about their portfolio quality. He's not wrong that selling at nearly face value is a positive sign, but selling 34% of a fund's portfolio in a single emergency transaction isn't something managers do when things are going smoothly. They do it when the alternative, running out of cash to meet redemptions, is worse. Here's where I want to bring this full circle, because I started with one number, $1.4 billion. That's what Blue Owl sold in days. But that $1.4 billion is sitting inside a $3 trillion private credit market, which itself is one piece of a global financial system carrying leverage and debt at historic extremes. The BDC sector alone faces $12.7 billion in debt maturities this year. Private credit's true default rate, per WithIntelligence analysis, is closer to 5% when you account for restructurings. Software collateral values have been cut nearly in half. Apollo has been quietly exiting software exposure for over a year. And now the first retail-facing fund gate has officially opened. In August 2007, BNP Paribas froze 3 funds. The official statements were calm, manageable, isolated. 13 months later, the global financial system was on life support. I'm not telling you the same thing is going to happen. I genuinely don't know. Nobody does. But I am telling you that the structural mechanics at play right now, illiquid assets, liquid-ish redemption promises, concentrated exposure to a sector under technological disruption, a maturity wall hitting all at once, and now the first high-profile gate, are worth taking seriously. Not with panic, with clear eyes and careful positioning. The people who got hurt worst in 2008 weren't the ones who saw it coming and got cautious. They were the ones who trusted the press releases right up until the moment they couldn't anymore. So here's what I want you to do. Watch the next 60 to 90 days carefully. Watch for other non-traded BDC announcements about quote-unquote redemption restructuring. Watch for continued discount widening in publicly traded BDCs. Watch for dividend cuts, Golub, BlackRock TCP, and any other fund with significant software exposure. Watch for news about the $12.7 billion BDC maturity wall and whether refinancings are happening at reasonable terms. And watch whether this week's panic across Ares, Apollo, Blackstone, KKR, and TPG was a one-day reaction or the beginning of a sustained sector repricing. None of this tells you what to do with your specific portfolio. That's what financial advisors are for, and I encourage you to have those conversations with a licensed professional. What I can do is make sure you understand what you're looking at when these headlines cross your screen, so you're not left trying to decode Wall Street jargon at the worst possible moment. Drop a comment and tell me this. Are you currently invested in any private credit fund, BDC, or alternative income product? Do you feel like the risks were properly disclosed to you? I read every single comment on this channel, and your real-world experiences help shape what I cover next. This community has been on the leading edge of these conversations, and your perspective matters. If this video gave you something your financial news feed didn't, a clear picture, a historical context, a framework for what to watch, then subscribe. Share this with someone who has money in private credit funds, and hit the notification bell so you don't miss what comes next. Because if this is truly the canary in the coal mine moment that Mohamed El-Erian and Dan Rasmussen think it might be, there is going to be a lot more to cover in the weeks ahead. $1.4 billion. That's where we started. It might be just the beginning.